So today we're going to talk about why investors are currently worried about the stock market and why there's a bit more negativity creeping in, and the stock market in general has been a bit more negative. Looking at pre-market's negative once again. Yesterday was a bit of a red day, so we're going to do a bit of talk about what's going on there. Before we get on to there, S4 Capital having a fantastic day today. It brought out its trading update in the morning at 7 a.m. Read the report. It was a pretty okay report, I would say, given the circumstances. In fact, it's probably a good report when you look at what's happened to the share price. You're probably looking at the report and going, how has that happened when you look at the share price? And then on the webcast, I think Martin Terrell put on his talking boots on what investors wanting to hear, and he said all the key things that were correct, and that's had the share price do absolutely amazing. So don't know if any of you guys are in S4 Capital want an update on that stock after the day that it's had today. Just let me know in the comment section, and also just to let you know there's a link to Trading Someone 2 in the description as well. If you join through there, you also get a free share worth up to £100. Someone actually got a Games Workshop share the other day which was like worth 80 quid, which is pretty good going. And if you're on the Patreon, I'll be dropping a live Q&A on there tonight, so just keep your eye out open for that one. But getting on to today's video, which is why are investors worried? Well, really the big drop in the share prices at the moment, especially the big tech, at the moment big tech has really been hit hard. Small caps, mid caps, growth stocks, like we talked about a few yesterday's video, they're at a lot better valuations, so they're not actually getting hit as much at the moment, but the big tech's getting hit hard, the indexes are getting hard. And when you look at like the S&P or the Nasdaq, for example, you'll see that that index is now starting to trend towards where it put a bit of a bottom in towards June time. So obviously investors are not quite happy with what's going on at the moment, and really negativity came back into the stock market through this. The inflation data has been the key thing. Now obviously, as you guys know, and we've covered on the channel many times, what happened is inflation data came out, everybody was hoping for a drop, which we got. However, it was not the drop that was expected, and after that everyone kind of lost it and went, oh, it's not dropping as quick as what it should be. In my opinion, I think, well, we're still moving in the right direction, but clearly Wall Street has not been impressed that it's not dropping as fast as what it should be doing, and that's obviously pushed, like we said, the S&P, the Nasdaq down recently, and there's a lot more negativity, as you can see in pre-market, we're down. Now the big thing is that's led to this today, the Fed. Now you guys, as you see this video, you probably know this. Very close, if the video might be up on just before this happens, but there's the Fed meeting today. So the inflation has put more pressure onto the Fed, and Fed having to raise interest rates. Obviously, one of the main things that the Fed can do is put higher interest rates out to try and curb inflation. So obviously today, what is happening, people are expecting to see a 75-point increase in the interest rates at the moment. Now, because of the inflation that happened, and I think this is absolutely crazy, but before the inflation, people were actually looking at the Fed going, okay, the economy is slowing down a little bit, hopefully inflation has another big drop. Can we, instead of going to a 75-point hike, a 50-point hike? And I think there was something like a 10% probability of that happening. Now, I cannot believe people were actually thinking we are going to see that reduction, because one of the main things that the Fed has constantly said is we need to get inflation back down to a decent rate. I think their rate they're looking for is 2% a year, so that's a fair bit away to go at the moment. So there's no way they're going to start slowing interest rates at the moment, because they still need a fair bit to drop. But clearly, because that was taken off the table, investors were not, or Wall Street wasn't happy about it. And then what happened is, because inflation was not what we were expecting, the stock market is now pricing in an actual 100-point increase. Now the chances of that happening, I think, is somewhere between 10% to 20%, so still quite a low percentage. Obviously today, if the Fed do come out with a 100-point increase, obviously that's the market will not like that if you see that coming out today. But if it's a 75 point, which is expected, increase comes out, maybe that'll calm things down just to see the Fed staying consistent what they're saying. Now, because of this negativity here, because inflation is a lot higher than what's expected, and because the Fed have the potential to maybe increase interest rates higher than what was expected rather than lower than what's expected, this has caused this negative market, which we're seeing at the moment. We're seeing the indexes getting hit by a negative market starting to get priced in again at the moment, and especially this time round it's a lot of the big tech rather than the growth stocks, because like we covered before, a lot of the growth stocks, a lot of small market caps are at a lot better valuation at the moment. Now the great thing is here, as us as investors or retail investors, is while this negative market is going on, obviously we're having amazing opportunities in the market to buying stocks, The more that these stocks stay down at these sort of prices, the better it is for us investors, because as long as we've got patience, we're getting stocks back at really good valuations. And a key thing of that is when we go back to June time and we saw us pushing them lows, it only takes very much a little bit of positivity and you see the slingshot move in the other direction. And this is the thing, while this is all piling pressure on the stock market, that's just building on, negativity. And I'm seeing negativity, like, I think I saw someone the other day was claiming that the Fed should, instead of a 75 point basis hike at the moment, increase that to 150 or something. And it was like, okay, that's when you start knowing you're in a negative market, when you're seeing things like that happening. But this is the thing, when the negativity builds up, the market always shifts heavily in one direction. The market can shift so quickly up and down, up and down. And you look at the market and think, surely sensible investors would just buy stocks and just keep adding, and stocks would, nicely tick upwards. But it doesn't work like that, because of the emotion like negativity or euphoria. At the moment we've got negativity, that can push share prices way below than what they should be, and assets way below what they should be valued. And that's what's happening at the moment. Unfortunately, until we break the trend of negativity, what we have is we can have stocks go to, very low valuations they shouldn't be, share prices they shouldn't be, while that negativity is building up. Now for us, that actually creates really good buying opportunities. However, like we said, in like June time or May time when we had the bottom, it only takes a little bit of positivity for us to swing back in the right direction. And that's the crazy thing with stock market, like emotions drag very extended to one direction. When you go back to, like December 2020, we had the stock market at quite high valuations, and everyone was kind of looking around at each other in December 2020 going, we're quite high valuations here. But unfortunately, even the Wall Street do this, not just retail investors. Retail investors can do this, and you see this quite a bit. I'd say probably 50% of people I've seen in the last few months do this. But even, the top Wall Street dogs, they can do this, is that they can look at, something like December 2020 and go, we're at really high valuations, a lot of euphoria in here, but because the sentiment's really positive, no one sees the day where we go back down to a negative market. People just kept buying, and we went through the likes of January, February, 2021. We kept going up, even though we should be down here at a lot more of a realistic valuations. And Wall Street got caught into that, retail investors caught into that, and eventually, as soon as that snap happens and we go back down to reality, unfortunately, same again, we investors aren't rational. They don't really look at things how they should be investing it, rather than cautious, gentle upticks in stock prices. It's always very much in the stock market, emotions, one extreme to greed or one extreme to fear. And then what we've had in this market is we've had, stocks, instead of going, okay, where they should be, and then, okay, we're going to have a nice little tick up, going forward through 2021, 2022. Then we go completely to the other side. And that's what we're in right now. We're very much dragged into that complete fear market. And it's same again, it's hard when you're in that market to break that trend. It was hard in February 2021 to break that ultra bullish trend when we were at crazy extended valuations. And now we're at the other end where we're in a really negative market, and it only takes a little bit of negativity to keep that market down there. We look at inflation. Inflation comes out, it's pretty good data, but it's not what's expected, so we go back down again. We look at the Fed. Okay, the Fed always said we're going to bring inflation down. They're going to say, a 75 point basis increase, and then they say they're going to do it, and then all of a sudden that's still taken in a negative way, even though we know that's going to happen. The market takes it in a negative way. And when that negative sentiment is there, which like it is at the moment, that negative sentiment is there, it's so hard to kind of break that uptrend. But same again, when that happens, when we do break that uptrend, whatever that may be, we kind of got a taste for it, like in May time, especially with the small and medium market cap stocks. We can't stay at restricted valuations, negative market forever. At some point, the feeling in the market changes, and we go back to a more of a neutral kind of view in the market. And then from a neutral point of view, once again, we'll probably get extended one way, we'll probably get extended more to a bullish way, or we could even go back down to a negative way. You never know. But same again, the market always goes through cycles, and when you are in a cycle like a negative market, which is being caused at the moment by the inflation and the Fed, it's always hard to break it, but then the days do come when it breaks and it moves very much in the right direction, and there'll be days where you move back into an ultra bullish market and you'll be like, do you remember having a negative market? How strange was that? And at the moment, it's quite a bit of a funny one at the moment, because I actually thought about this the other night, and I made the video yesterday and I said, I really do think that 2023 is going to be a good year for the stock market. Potentially when we get to November time, December time, we might see a bit of positivity. We might see the inflation data worry. We might see, the recession at the moment start moving a bit more out of a recession. We'll see what happens towards the back end of the year. And most companies are coming out and saying that they're very bullish towards that back end of the year. So we'll see what happens. But I thought it will be a big statement if we do leave 2022 with like the S&P down 20%. If we leave the 2022 with like the Nasdaq down nearly 30% or something like that. To actually say that we've been through the worst stock market since 2008, the worst stock market in 14 years, and you consider, when you think about 2008 and the levels that we got to in that time, where you were talking about, the banking system was on the verge of collapse, and some of them did collapse. You had the housing market completely collapse, employment absolutely collapsed. 2008 was bad. It was a really big time period, and we are now going to the closest thing towards that period. And I don't know about you, but you do look around and you think, does when you look around here, like obviously there's a few issues in the world at the moment, but when you look at the negativity that we're priced in at the moment, can that last forever? Is there going to be a breaking point before eventually everyone kind of goes, oh, actually the worry about inflation has moved back in, we don't have that anymore. The Fed has stopped worrying now because inflation's now peaked. Is that going to happen in the next few months? Or the Fed's now not worrying about inflation because it's peaked, and now they're lowering the interest rates, and now everyone's going, oh well, interest rates are coming down now. That's a bullish sign. Will that will eventually break the negative market? Probably at some point that will be the cause of what breaks the negative market. And there's no ultimate time frame of when this stock market's going to bottom. That's the tricky thing. But at some point, whenever that will be, Wall Street and investors will go, actually we're all right now, and that negative market will be broken. When they choose that to be, we don't know. Is it going to be when inflation comes from 8.3% down to 7.5%? Is that going to be when it goes down to 6%? Is that going to be when it goes down to 5%? Is it when the Fed goes, oh, you know what, we're going to slow down interest rates now to 50 points, and we're going to slow it down to 25 points? We don't know when the key point is, but at some point that negativity will be broken through one of those things. And then very much like we see, we've had so long in a period of time where you could have bought stocks in this kind of downtrend, and you'll very much you'll see stocks very much go on the uptrend, and you'll see people at this point here still jumping into stocks, and you'll be like, why are people chasing stocks when we've been down in this sort of margin for 12 months? You could have bought stocks in this sort of range for 12 months, and now you see people carry on chasing the stocks up here, and it carries on going up, and they're still chasing up here and chasing it up here. And you'll see that as soon as we very much flip in the market and go more to a positive and more of a greedy market, you'll see people chasing stocks on the way up, and you'll be looking going, but we had 12 months to buy that these sort of valuations, why were you not doing it then? And you'll look at yourself and go, well, I bought it and I've got the rewards from that. And that's the big thing, you want to be kind of capitalizing in that opportunity. And you'll notice very quickly when we do go in the bullish cycle, you'll see people chasing them stocks. We had it in, through that kind of May, June time, and stocks started going up a fair amount, and then people still buying in, and you're like, well, you could have bought at these valuations for such a long period of time, and those will be the people that are better off anyway. So yeah, just want to talk about this and some of the reasons why investors are worried in the market, when they will stop getting worried in the market, what will have to change, and also the benefits of buying into this scared market at the moment with retail investors and Wall Street as well. Don't think it's just retail investors. Happens to Wall Street. Wall Street are the ones that have the big money that moves the stocks as well. So I hope you enjoyed it anyway, guys, and smash that like button. I'll catch you in a bit.